Right. I believe. Okay. I believe we're live. I understand from that AI voice I just heard. So, hi everybody. Welcome to the EFAMA Fact Book webinar 2026. My name is Dan Owen Brown. I'm the Director of Market Insights, Data and Analytics at EFAMA. And today, a colleague of mine, Thomas, will be presenting the 24th edition of EFAMA's Fact Book report. So it's a really in-depth analysis of the key trends in European investment funds. It's published on an annual basis. There are several interesting boxes, which Thomas will be discussing a little bit, I believe, on currently relevant regulatory topics, which we include every year. There are also country reports. These will be separated out for this edition and will be published later in the year as a separate deliverable. And then finally, we have also, I believe Thomas will give some more details, but we have 10 sponsors of the fact book this year, which are present in the report. And so I'd just really like to give them a great thanks for their support for the production of this year's report. So we can go straight into it, I would say. As mentioned, our speaker presenter today is Thomas Tilley. You should see him on the screen. He's Deputy Director of Research and Senior Economist at EFAMA. So he's been with EFAMA since 2017. He focuses on research topics related to the fund and asset industry, which is handy. He has a lot of knowledge of what we will be talking about today. And he's actually the main author of our ongoing reports and the work we do in this area. So he'll give an overview. He has a presentation. I believe it's already on the screen, actually. He'll give some main findings of the fact book. Just in case you have questions, there should be a chat. I believe it's already open. So as we go along, you can put in questions. We'll most likely address them at the end. That's it. I'll hand over to Thomas for the presentation.
Thank you, Dan. Yes, so indeed, if you do have questions, don't hesitate to put them up in the chat so we can address them at the end. So our fact book, it's the reference for information on the European investment fund industry. We do really in-depth analysis. Full boxes this year on files that EFAMA is actively working on, market integration supervision package, retail investments, anti-money laundering, pensions, the digital omnibus. There's a fair number of them. Every year we also try to innovate a little bit in the data we show, as we do. So this year we added data on the number of funds and average fund sizes by different types of funds. A very granular breakdown on the type of funds insurers and pension funds invest in, and also figures on what percentage of households invest in certain types of assets. These are our sponsors, so warm thank you to all 10 of them. This fact book would be very difficult without them. So let's dig into it. What happened in the UCITS market? So the focus of the fact book is always what happened in the previous year. So this will be 2025 with sort of a longer time perspective of the past decade. So UCITS markets. 25 was actually a record year for UCITS with 814 billion of net sales. We just beat the 2021 record by 1 billion. Inflows were quite robust across all main UCITS categories, with especially bond funds attracting 300 billion. Also, equity funds did quite well. This was so what's behind this? Stock market evolutions. The stock Euro 600 returned about 20%, so quite a nice return in Europe. S&P 500 also returned 18%. What influences bond funds? It's mainly interest rate evolutions. So the ECB cut rates 4 times in 25. Also, other major central banks, the Bank of England, the Swiss National Bank cut interest rates. Interestingly enough, multi-asset usage recovered, so they had outflows the previous 2 years, and now inflows returned. We'll circle back to that, but we also had 145 billion of inflows in money market funds, and this is still quite high, and it's not as high as it was the previous years, where we had sort of a inverted yield curve, meaning short-term interest rates were higher than longer-term interest rates, which made these type of funds very attractive. In 24, the yield curves normalized, and in 25 they steepened a bit, so returned to normal. But we still had these high inflows, and that shows that for a lot of investors, they took sort of a wait and see attitude in a very volatile market environment, with stock markets going up and down and geopolitics all over the place, tariff turmoil. So this a big chunk of investors did decide to go in these money market funds. Let's focus now a bit on the equity usage market. The first interesting trend here is this is the asset allocation by region, meaning where are the big companies that they buy, that UCITS equity funds buy stocks from, are based. For a long time, almost a decade, we saw a steady increase in the share of US companies in the asset allocation. This was due to the performance of US stock markets, which was just better than European stock markets. Also, the success of UCITS as a global brand, meaning international investors are often making use of UCITS to invest in global funds. It's also related to these global index trackers, which track like the MSCI World, which has like more than 70% exposure to the US stock markets. But in 25, we finally saw a decline of the market share of US stocks and an increase in the share of European stocks from 30 to 31%. This is helped substantially by a depreciation of the dollar against the euro. I think the dollar declined about 12% over 2025 due to all the tariff issues that were mentioned before. If you look at what type of equity funds sold well, we also see some interesting shifts there compared to last year. This year meaning 25, we saw a rebound in European focused funds, so funds that center on European stocks. It went from solid outflows to solid inflows of 60 billion. This was due to, on the one hand, investors diversifying away from the US, being a bit concerned about overvaluation in certain parts of the US stock market, and pretty sound macro fundamentals in the European markets. We still had outflows in the UK. This is mainly driven by retail investors. In the US, though, where it was for years US focused funds, so funds tracking the S&P 500 and so forth, we had really strong inflows in 24, and they dropped to almost zero in 25, just because investors were diversifying away from US markets, and this depreciation of the US dollar, which made it less attractive for European and international investors to invest in the US markets. But the main seller this year, just like last year and the year before, were still these global funds. So funds investing in worldwide stocks, often large cap. This is still driven by persistent demand for global index ETFs. So we circle back to the ETF market later, but there is just incredible flows of money going into these global index ETFs, despite the fact of depreciation of the dollar. Sector-specific funds also rebounded. this was mainly driven by financials and industrials who saw solid inflows. If we turn to the bond usage market, flows here all, as I mentioned before, are driven by interest rate evolutions and geopolitics. And we see actually robust inflows across the board if we look at what type of bond usage saw inflows, with especially strong inflows in the flexible bond funds and also in short-term bonds funds and ultra short-term bonds funds. So bonds investing in debt securities with less than 1 year of maturity, meaning that there was still some investors tend to choose shorter term securities when they're uncertain about how the market will evolve. And these flexible funds were quite popular because they can easily shift their asset allocations in years of volatility and interest rate evolutions. But also like the more risky parts of the bond fund markets, like high yield funds, emerging markets, still saw solid inflows. So it was broad-based, those inflows. The one category of bond usage that saw outflows, and that they've been seeing it for 2 years now, are inflation-linked bond funds. That was because these type of bond funds really failed to protect investors in 2022 when you have this large bout of inflation that hit investors quite hard. So they sort of lost confidence in these type of instruments. If you look at the asset allocation, what's quite noticeable was this shift towards shorter term securities in recent years. So it shifted in, especially if you look from 21 to let's say 24, there was really a shift towards short-term securities, so less than 1 year and between 1 and 3 years. And that was driven by this like inversion of yield curves I mentioned before. Since the yield curves have stabilized, so they stabilized in 24 and steepened more in 25, you would expect to see a shift more back towards longer term maturities, but that hasn't really been the case. And this is again because investors preferred shorter term maturities in these times of geopolitical tensions. So we will have to monitor how that evolves over the next years. The multi-asset usage market, as I mentioned before, we had 2 years of net outflows. So with especially large outflows in 23, when investors were completely this type of funds, because normally what they do is, why do you invest in multi-asset funds? Because you spread your risk by investing in 2 asset types that are more or less uncorrelated, bonds and stocks. In 22, you had a big decline both in bond and stock prices. So investors moved out of these type of funds. They moved into bond funds in 22. They stayed out in 24. This year, they moved back again, meaning that some investors believe the correlation between stock and bonds have returned back to normal. What I also wanted to flag here are the sector allocation. So the equity part of assets, so multi-asset usage, what's their allocation to specific sectors? And this is the main sector, the largest sector is the technology sector. And you see how this has just consistently grown over the years, rising for multi-asset from 12 to 23% and from 13 to 25, so almost doubling over 15 years. And that in recent years has really been fueled by the AI boom. And I think given the recent IPO of last week and the 2 upcoming ones for Anthropic and OpenAI, I think this will even rise further over the course of 2026. Returns. So we're looking at returns. These are the average performance of long-term usage, broken down in active and passive usage. Overall, we see that passive funds, so these are the net returns, so minus cost, passive funds tend to outperform active funds on average in most years. Does this mean you should just buy passive funds? Not necessarily. There is a wide variety in returns across different funds. For example, if you there was a small network issue, but I think we're back.
Yeah,
active.
You're okay, Thomas.
Yes.
There was a cut, but you're back. Yeah.
Sorry about that. My internet. Active bond funds tend to outperform passive bond funds. But overall, and this is mainly in the equity market, the passive on a net basis and on average outperform. What happened this year, so this year meaning 25, returns were in general a little lower than the 5-year average. Sorry, can you see me?
Yeah, you cut, but you're back now, Thomas. Yeah.
This is annoying. Money market funds saw actually negative returns of -2.5%. And that was again due to this big depreciation of the dollar versus the euro, as European money market funds invest a large part in this short-term US debt securities, T-bills, and the like. And given those strong depreciations, this resulted in sort of a negative return for money market funds in 25. Looking at ETF. Can you hear me?
Yeah, you're back. I wonder if video might, I don't know if you want to, but we can carry on and we can see maybe cutting video at some point could help if you're having issues.
Let me just see if I can. Yeah, I think it's better. No, it's still quite low. Okay, this should be quite a little better. So let me put this back on the big screen. ETFs. So third consecutive year of record net sales. 347 billion in net sales this year. If you look at the whole long-term usage market and the equity market especially, all of the net sales in the equity usage market were actually due to ETFs, with non-ETFs equity usage actually seeing net outflows. This was not the case in the bond market, the bond fund market, where actually the bulk of net sales were still in non-ETFs. But this trend, this rising boom of ETFs is a trend we don't see stopping anytime soon. Sustainable funds, they continue to face headwinds. So SFDR Article 9 funds, so the so-called dark green funds, saw net outflows in 25, just like in 24. On the other hand, those so-called Article 8 funds, the light green funds here, the blue ones here, saw an uptick in their net sales, and especially Article 6 funds, so the funds with no sustainability objective at all, saw a boom in their net sales. This again was driven by the sustained success of ETFs, as most ETFs, they track broad global indices and they have to be labeled as Article 6. Most money market funds are actually Article 8, so that's what's driving a big chunk of these Article 8 net flows. So all of this shows that the SFDR 2.0 that's coming up is really warranted, because the market at the moment for these Article 9 funds is not working. Looking at the alternative investment fund markets, net sales actually were quite muted, 140 billion, a little uptick compared to last year, but they're still heavily influenced by evolutions in the Netherlands. The Netherlands, with this massive second pillar pension fund market, they have these big pension funds that have AIF wrappers, and they are shifting these AIF wrappers to segregated mandates because of change in prudential supervision rules, making it slightly cheaper to manage those pension funds in a mandate. So it resulted in about 70 billion of net outflows this year from the Netherlands. So without the Netherlands, we would actually have had the double in terms of net sales. AIFs also follow a completely different sales pattern than UCITS. As the investor base is mainly institutional, there for years we do see multi-asset UCITS as being multi-asset AIF, as being the main seller. This is to a large extent driven by Germany, where you have these special funds for institutional investors, which invest in a combination of assets. These outflows in the equity market is what I explained, is mainly the Dutch pension funds. But what's also quite striking are the outflows from real estate funds. It's the second year of outflows, and outflows are actually second consecutive year or actually increasing, meaning that there is an issue in the real estate market. Even though housing prices went up again this year, there is a structural shift away from this, and this is probably to do with, if you're looking for a low risk investment, now with interest rates higher, certain investors are just going into bond funds and into bonds, that securities, and less so into real estate funds. Also, after the pandemic, certain segments of the real estate markets, like commercial real estate and so forth, have been hit. So we are seeing continued outflows here. Other AIFs, which are the more illiquid ones, private equity, private debt, infrastructure, are seeing solid inflows, and they've been seeing that for a while now. Longer term, we see a rise in closed-ended AIFs. So closed-ended AIFs can't be redeemed so easily. So that means they can invest in more illiquid assets, like what I mentioned, private debt, infrastructure, and so forth, with slightly higher yields there. So there is a growing investor demand in private markets. And a lot of this is driven also by the popularity of the so-called RIVs, the Reserved Alternative Investment Funds in Luxembourg. If you look at the asset allocation of AIFs, what is consistently growing is how much AIF managers invest in other funds. It grew from 24% to over 31% over the past 5 years. This is really showing how AIF managers are making use of passive funds and ETFs in their own asset allocation. Longer term trends. The switch toward passive, it's very clear. It just was rising strongly. It rose especially strong in 23 and 24. It still rose by about one percentage point in 25, meaning it leveled. the pace of the rise slowed down a little bit, but it's still growing. Lower costs, ease of access, and high liquidity of ETFs, which are mainly passive still. Combined with this, there is this continued shift towards larger funds. There are a lot of funds in Europe. I think there are more than 11,000 funds smaller than 100 million, but they only represent 2.8% of the market. And this share has steadily declined from just under 6. And then you see here funds larger than 1 billion, and especially funds larger than 10 billion, are seeing a massive rise, meaning that there is a concentration in the UCITS market, again driven by ETFs and money market funds, which have like economies of scale, which push investors into bigger funds. Combined with this, costs are coming down. Average cost of long-term funds is decreasing for active funds especially, but also still for passive funds, even though it decreased less because it started from a lower level already. This is driven by heightened transparency on fees, intensified competition across asset managers, competition between active and passive. If you look at across the main fund types, we see a general decline, especially in the equity market, where it declined by about 18 basis points over 5 years, a little less in the bond market. Multi-asset funds actually are still the most expensive and saw prices only drop by 1 basis point. This is because they mainly have more complex strategies and invest in a combination of assets. They often also make use of other funds, or are funds of funds, meaning their costs are slightly higher. Money market funds have very low costs, but the cost has come up a little in recent years. This probably has to do with like exchange rate effects and hedging for exchange rate effects. As I mentioned, there was the big depreciation of the dollar. Is the European fund industry becoming more international? Yes, certainly. And you can look at it in 2 ways, because you can be international inside the EU, cross-border funds, meaning funds domiciled in Luxembourg or Ireland that are sold in Italy or Germany, or outside the EU, meaning European cross-border UCITS that are sold in Asia, in Latin America. So we see actually the share of cross-border funds held in another EU country has grown the most over the past 10 years. This really confirms the vitality of the single market for UCITS and AIFs. But also there was a really brisk growth in funds held outside the EU, and this is mainly due to UCITS. UCITS really is one of the EU's most successful export products. UCITS are now sold in 50 countries beyond the EU, mainly in Asia, with especially Hong Kong, Singapore, and Taiwan as big markets. But UCITS are also sold in Japan, for example, in Latin America, in Chile. Chilean pension funds make use of UCITS. We had a market insights on this out in September last year. It's on the website. So if you're interested in specific country level data there, it's there, and we will do an update of that one in the later months of this year. Who is investing in European funds? So the main investors are pension funds and insurers, households, and long-term investment funds. This is because this data I sourced from the ECB, and they look at the first investor in the fund. So not the ultimate investor, but the first investor. So these long-term investments here are sort of a double counting, if you will. What are we seeing in terms of market share? The share of insurers and pension funds is steadily declining. That doesn't mean the amounts they invest in funds is declining. It just means the other types of investors have grown more. It's also partly related to this, what I mentioned before, these Dutch pension funds converting to mandates. But what is clear is that since 21, we actually see a steady increase in how much households, the market share of households in investment fund ownership. And this is confirmed by the net acquisitions, where we actually see steady net acquisitions by households across the past 5 years, with 25 seeing a new record in acquisitions by households. Almost 300 billion of funds were bought by EU households in 2025. Let's look a little deeper at those trends in the retail market. These are the net acquisitions of financial assets by EU households. So what do EU households invest their money in? Mainly, they buy deposits, as we can see here. In 23, there was actually quite large purchases of debt securities. This was due to quite successful bond issuances in Belgium, for example, but also in Italy, in Germany, of governments trying to sort of push the banks into raising interest rates a little bit. And this was actually quite successful. And this also was a bit of competition for investment funds. 24 saw this trend reverse, with really money moving back into deposits and savings account, but also into money market investment funds. And then in 25 we have these record inflows into investment funds. And what's quite striking here is, if you look at the last 2 years, direct investment in bonds by households has dwindled to almost nothing. Direct purchases of listed stocks by household has been almost close to zero, or even negative, like this year, it was negative. So if households want to have direct exposure to capital markets, they make use of investment funds. That's really the way they access capital markets. I mean, they buy their pension funds and they invest fixed amount in their pension funds, but to actively make the decision to invest in capital markets, they make use of investment funds. In terms of which countries, it's really been German households that are buying the bulk of funds in Europe. This is due to the success of these ETF saving plans, which are really taking off. But we also had quite strong purchases by households in Spain, 50 billion. They, interestingly enough, tend to be a bit more conservative and buy more bond funds, even though I think the Spanish stock market did really well in 2025. Italian households also buy solid amounts of investment funds. France, Belgium as well, Poland. These is only the top 10, but almost all countries saw positive inflows, indicating there is really a broad-based trend into funds. And this is also driven a bit by the rise of these neon banks and broker platforms, where it's really easy to buy platforms, and especially young people are investing a lot directly, often in ETFs, but not only. So these are the trends in the retail investor market. Now, if we circle back a little bit to the insurer sector. So insurers are one of the main clients of investment funds. And as you can see here in yellow, if you look at the asset allocation of insurers, the share that they invest in investment funds has just been steadily increasing every year. I mean, there was a small dip in 23 here, but it's really been steadily growing. And this reflects the crucial role funds play if insurers want to adjust their regional or sector diversification, if they want to access equity markets, especially, they do invest directly in equity, but it's actually rather low, and this is despite the strong growth of equity markets over the past decade. It's only 16% that insurers invest directly in equity. Costs also play a role, as we shown earlier. Fund costs have come down, especially in the institutional market. So this makes it quite cheap for insurers to make use of costs of index funds and so forth to adjust their asset allocation. If we look at what type of funds insurers invest in, it's actually quite a large chunk is in equity funds, as I mentioned. So they really do make use of funds to gain exposure to equity markets. Of course, insurers are constrained by Solvency II rules, which means there is only a fixed amount they can invest in equity markets, and especially in alternatives. But we do see a rise in alternatives here. For example, infrastructure funds, it decreased from 1.6% to 2.6%. Private equity from 3 to 3.9%. So they are shifting a little bit more towards alternative funds. And then if we move to the pension funds have always invested a large chunk into investment funds. And this share has actually declined a little bit. Again, this was due to this restructuring the Dutch pension funds, which are sort of muddying the data here. So that's why it's actually declined a little bit. Especially there was this big outflows in 22, which results from this drop from 45 to about 40 here. But if you look into what type of funds they invest, there we really see a switch towards alternative funds. There is this switch, this growing share of infrastructure, real estate, private equity, and that is because these illiquid asset funds tend to offer a higher or more guaranteed yields, and they are actually the perfect vehicles to invest in for investors with a very long-term investment horizon, like pension funds. So this is an interesting evolution we're seeing here. This big drop in the equity here is again related to the Dutch pension funds fund reforms. It would be less noticeable if the Netherlands was excluded. That's all on the investors. Let's go quickly into the global fund markets. We also have a chapter going into the global trends in the global markets. This data is supplied by the IIFA, the International Investment Fund Association, of which EFAMA is a member, and of which also EFAMA's member organization are a member. Looking at worldwide fund sales, they dropped slightly compared to the record year that was 2024, but they're still above 3 trillion in net sales. Just like last year, net sales were mainly driven by bond funds and money market funds. Those were really the best sellers. We saw, just like in Europe, multi-asset funds after 3 years of net outflows actually returned back to positive territory, but still remain quite low. In terms of the regions, the US and Asia, who had both record sales year in 24, so actually net sales decline a little again, whereas Europe saw some net sales increase. If these numbers aren't exactly matching with what I showed earlier, is that we are just here taking only open-ended, substantially regulated funds. This is to compare funds across the world. So we're taking all the UCITS and a chunk of the AIFs. If we look at maybe the trends in the two bigger regions in the US, so after the record net sales of 24, net sales declined a bit, but they were really focused. All the flows come from money market funds and bond funds. Why money market funds? The money market fund market in the US is really retail driven. So households in the US just invest in money market funds. This started really after the collapse of the Silicon Valley Bank, which coincided with the rise in interest rates. It's really easy if you're a US retail investor to invest in money market funds, as opposed in Europe, where it's almost impossible to buy money market funds. So almost everybody does it at higher interest rates than savings accounts. Bond funds also saw solid inflows, but what's quite striking is actually the outflows from equity funds. We saw small outflows from equity funds, which is rather surprising at first glance if you see that the S&P 500 returned about 18%. But what happened there is a portfolio rebalancing. So, like I said, the US market is mainly a retail market. So all those American investors, they have their 401k pension funds, which often invest in, have fixed portfolio allocations or have target date funds as a fixed option to invest in. So what happens there, if the equity prices increase or increase more than the bond funds, if you have like a fixed proportion, let's say 40% equity, 60% bond, and equity increases more, that ratio drops. So the ratio of equity will increase and the ratio of bonds will drop. So automatically those funds sell equity and buy bonds. And often these target date funds make use of other funds, mainly index funds, so equity and bond index funds. So those are really, this is really driven by this portfolio rebalancing in 401ks. In Asia, flows were really driven by money market funds here in China. China, just like the US actually, has really a really well-developed money market fund market, where you have these massive money market funds where it's really easy to put a little bit of your savings on your phone. You can put a bit of savings quickly in the money market funds. So there, the bulk of those money market funds inflows were driven by China. The equity inflows, which were quite substantial, were also driven by China, but also Japan and South Korea. All three of those stock markets did really well. The MSCI China had a return of 30%, Japan at 16%, and KOSPI, the Korean main stock index, actually returned 76%. It was the highest return in decades, and also I think one of the highest returns of stock markets in the world. So this sort of drove those inflows into the Asian market. I think this is about everything I wanted to say in this presentation. There's a lot more in the fact book, but for that you'll have to read it and go through it. And I'll be very happy to see if there's any questions. Feel free to drop them in the chat.
Yeah. If there's anything anyone wants to ask, feel free. Just to go ahead myself, actually, I was wondering, just your slide 6. So you're talking about the share of European equities in UCITS portfolios.
Yeah.
So I'm just wondering what your thoughts are. Is this just maybe a blip? Maybe it's 1 year, so we can't say it's a trend yet. What are you thinking will be happening in the next few years here?
Yeah, I think honestly, I don't think this is a structural shift. It's encouraging that the European focus funds rebounded in 25, but I think it has more to do with the depreciation of the dollar in 25 than with the structural shift. I think especially now, if you look what's happened so far in the stock markets in 26, those big tech IPOs in the US will probably continue to drive the market share in the US up again, which is an issue for Europe because this is European, not only, but a big chunk of European savings are funding here the US economy. So I'm afraid it's more like an anomaly than a structural shift.
Yeah. We can go, there's a message in the chat, which I guess you can also read it, but I can read it out for everybody. To see if you have a thought around that is compared with other European markets, is the Italian asset management industry becoming increasingly concentrated in the hands of a few large players? And if so, what are the implications for competition, distribution, and product diversity available to investors? So comparing Italy, I guess, with the European market overall, have you
I
seen
mean,
anything specific?
so we don't treat it in this report, but we do treat it in the asset management report. There is overall an increased concentration in terms of the players in the asset management industry. This is driven by declining profit margins and driven again by declining costs. In Italy as well, but not just in Italy. We've seen big mergers in France and so forth. Implications for competition. I mean, costs are massively going down. So I don't think for investors this is necessarily bad news. So there that's actually a good evolution, even though we do have an increased concentration. Distribution, product diversity. Oh, it's hard for me to say that. My thinking is not necessarily. It we haven't really seen that. If you look at the terms of products that are available for investors, I don't necessarily think that. What is the case is that traditional asset managers in most countries, I mean, and in the continent, they often rely on a bank distribution channel, are getting more competition from, as I mentioned before, these neo brokers, these online platforms, and this is a trend we see across Europe. So there is the competition with the online sales of funds, which often go into ETFs, but they often do have a wide range of funds available to buy. So I don't think this increase in concentration is gonna impact. Definitely, it won't have increased costs for investors, and I think distribution and product diversity won't be massively impacted. But that remains to be seen, of course.
Okay. I was interested in maybe just the net returns that you talked about. The 1 year returns seem to have been yeah, exactly here. I was just wondering, generally, is this something you worry about, or are we more focused on long-term returns? Is it something you think is an issue or not really?
I mean, yeah, this gives a 1 year picture. We exactly put the 5 year returns to show that if you invest for a longer time horizon, your returns will remain quite good. I don't think this is something to worry about. As I mentioned, they were negatively impacted by this depreciation of the US dollar. So I don't think this is a big issue. If you look also so far, what seems to be happening this year is that markets have responded quite well despite the conflict in the Middle East. So for if you invest with a long time horizon, I don't think this dip in returns is an issue at all.
Okay. We got another one coming in actually, also in the chat, is around active ETFs. So do we have any thoughts on the implications of the increased adoption of active ETFs for the asset management industry? We put out a market insight on this, I believe, at least for the trend. I believe it was last year, but if you have some thoughts around that, go ahead.
Yeah, so it's a big trend we're seeing. The market share is still small. I think it's still under 5%, but it's growing rapidly. So we often have asset managers converting their range into active ETFs. And what's interesting there is that actually those active ETFs, even though they're active, tend to be cheaper priced than traditional mutual funds. So it's something I'm convinced we're gonna see more of rapid growth. In the US, they're a bit further ahead, so the market share is higher there. So a trend to watch, active ETFs, absolutely.
Yeah, and another interesting one also just came in. I can also read it out. So it's about passive funds. Yeah, exactly. The chart about passive funds gaining market share, which is a trend that you highlighted. They're saying that growth seems to be slowing, I suppose. Is it going to level off, I guess, is the question at some point? Or do we expect it to continue forever in some kind of slow upward and to the right situation?
I mean, so indeed, growth slowed down a little this year. It's only because growth was so strong in 23 and 24. I think it will still increase. If you look at the US, I think passive is about half there. So if we were to go to the same situation as the US, it still has 20% to grow. I'm not sure we'll end there, but I don't think this trend towards passive is gonna stop. The speed of growth will depend on some things. It's like the active managers are fighting back by launching their active ETFs here. So that's probably maybe what slowed down the pace of growth a little bit here as well.
Yeah. That's great. And actually another question that's just come in was something I was thinking about, is more forward looking and what we consider are the main trends. So they're asking us, what's the one trend highlighted that you will believe will most fundamentally reshape the industry?
I mean, one trend is really hard. So I'm gonna do three. So passive will continue to rise. And this one is also a crucial trend. The growth of the internationalization of the European fund industry. This is a key element that's often missed also by European policymakers, how successful UCITS is as a financial export product. This is something we are convinced that will continue to grow. And then the last one is the one here is the continuous, relentless decline in costs, which is great news for investors, but it's putting pressure on margins for asset managers, and profit margins are declining because of this increased competition. So this is probably the biggest challenge for the fund industry, is this declining costs, which are making it harder for profit margins in the industry. And is, on the other hand, this drives that push into concentration and into larger funds. So it's all related, but declining costs and declining profit margins is probably the biggest uncertainty and challenge for the industry?
Perfect. Actually, I quite like that forward-looking question as maybe a closing question. So I don't see anything else coming up, and that was my end thought as well. So I think we can probably close it there.
Maybe just lastly, if anybody has any more questions they can't think of at the spot, just send me an email. The presentation will be shared. My email address is at the last slide. So send me an email and then I'll get back to you.
Yeah, exactly. So thanks, Thomas, for your time. That was great. As Thomas said, the report is pretty extensive, so feel free to take a look through it in more detail on your own time. And that's it. Thanks, everyone, for attending. Have a great rest of the week.
Thank you very much.
Bye-bye.